Welcome back. Yesterday, the word of the day was trade, with impeachment talk raising concerns about congressional Democrats backing the USMCA. But this morning, House Speaker Nancy Pelosi said she's moving ahead with that trade deal to replace NAFTA. All this after President Trump yesterday said a China deal could happen sooner than we think. If trade fears begin to quiet down, could liquidity become the next major concern for this market? For more, let me bring in Mike Feroli. He's chief U.S. economist at J.P. Morgan, and Kevin Mahn is chief investment officer at Hennion and Walsh. And it's great to have you both here. Kevin, let me just first ask you about the trade situation. One of the biggest concerns yesterday was that on the market was that USMCA might not move forward. Other trade deals could get hung up. Is it looking better today? I mean, people were starting to say they're worried about Trump pulling us out of NAFTA if all of this goes belly up.
It's hard to imagine that this Congress and this administration is going to agree on anything between now and November 2020. Right. But if we get ratification of USMCA, that's a net positive, because it means that what was tentatively agreed to between the U.S. and Japan yesterday might move forward, and ultimately maybe something between the U.S. and China.
Right.
That's good for the markets.
Yeah, you're right about the Japanese trade deal, which we shouldn't overlook. But are we talking about the 10-year yield going from 175 to 3%? I mean, how big of a move are we talking?
I certainly don't think you're going to get to that level. And I think what's created all these liquidity concerns was some of the overnight repo issues that took place last week. And a lot of people are hearkening back to the days of 07, 08 when overnight repo rates skyrocketed. But I think this time is different. I hate to fall back on that age-old adage, but this time is different. We have a strong underlying economy, and what we're finding that it's very hard to pull ourselves out of this massive QE that we put into the system following the Great Recession.
Right. And Mike, that's exactly why I wanted to speak to you about this, because you have people saying now, wait a minute, the Federal Reserve has to go back and do more quantitative easing because of all of these issues. What is happening in terms of the monetary policy impact here from the drying up of liquidity?
Well, I think ideally the Fed would like it not to have monetary policy impact. In other words, they see this as dealing with the plumbing of the interbank system and the financing needs of that system. And monetary policy should be set on on its own course. And I think you heard that from Powell last week, which is these issues in the repo market, they are important, but they're probably not having much impact on the broader macroeconomy because it's really not affecting interest rates that are available to households and businesses. And so if that's the case, you shouldn't really expect a big macro impact. And I would agree with the previous, with what Kevin said, is that this is different from 07. You're not really seeing signs of worries about banking system health. So this is very different from 07.
But Mike, did they pull too much liquidity out of the system as they've moved to tighten conditions and raise rates? Is it an indictment of what the Fed's done here?
Well, I think there's, a case can be made. I don't think anyone knows for sure, but it does seem like we may have overshot and that the Fed will have to increase the total amount of reserves in the banking system. So, they're learning by doing just like everyone else here, and they may have overshot a little bit. But again, I don't see it as a huge problem. They've been able to control the repo rate ever since last week when they started coming in and doing these open market operations. So it's not a problem, but they may have overshot a little bit.
If they have to increase reserves, though, is that the same thing as quantitative easing?
Well, I think there is a difference insofar as QE, quantitative easing. The aim of that is to push down longer-term interest rates. The buying here to supply liquidity to the market wouldn't necessarily be out for buying longer-term securities, and so it wouldn't have necessarily the same impact on longer-term interest rates.
Kevin, would you agree with all of that? We have seen markets calm down a little bit in the sense of the rates settling back down, but demand, especially for the 14-day facilities, it gets people over the end of the quarter, because the quarter ends tomorrow. Demand has been very, very strong for that kind of product.
And that's the key point there, Kelly, is that liquidity peaks during quarter-end periods, and we have another quarter ending on Monday. We saw at the end of 2018 repo rates skyrocket up to 6%. So I think the Fed is trying to get ahead of that now, and they're going to use their balance sheet to do that. And perhaps they tighten too quickly with respect to trying to shrink their balance sheet, and they're trying to adjust for that going forward.
So does it then, and Mike, I'll ask you, but does it provide a boost? Does this juice the economy? I mean, we focus so much on whether they're going to cut rates and so forth. If they're putting more reserves into the system, what impact is that ultimately going to have? Is that going to mean there's more for banks to lend out and so forth?
No, I don't see that. They're just controlling these disruptions, and it would only provide a boost to the economy if it actually lowered interest rates below their target, right? They're keeping the Fed funds rate and repo rates around where they want them to be. And, look, reserves have come down quite a bit for regulatory reasons, banks are not well able to kind of intermediate that activity to bring interest rates back down, so they're having to do these operations instead. But they're just keeping interest rates where they want them to be, rather than having the market move it above where they had targeted.
Push it higher. Kevin, real quickly before we go, people have flagged concerns about there not being enough liquidity in bond markets, sometimes even in stock markets, and now we have this overnight funding issue. Is there a larger problem here that we're not seeing?
I don't think so, and I think it goes back to the fact that we still have a slowing but growing economic base to sit on top of. We're going to see Q3 earnings come up positive. We're going to see Q3 GDP hovering around the 2.2% level. We have a strong, confident consumer. I believe we're going to have a record holiday shopping season. I think these liquidity concerns are more short-term in nature.
All right, we'll see if we can get through the quarter and maybe put them in the rearview mirror. Thank you both. Appreciate it, guys.